Did you know that tariffs between the U.S. and China, which reached 145%, might drop to 30% this July? This isn't just about markets. It directly affects our wallets. Today, you'll understand how this decision can influence inflation, transportation, retail, and financial assets. Stick around until the end to learn where to invest smartly. Already subscribed? Leave your like, share, and comment with your questions right now. U.S.-China tariff context. In April, tariffs between the U.S. and China peaked at 145%, but they're on track to drop to 30%. This move has been in the works for months, with global impacts already taking shape. The next decision date is July 8, 2025, a key moment that could trigger big swings in the stock market, inflation pressures, and transportation and retail costs. The market is on high alert, closely tracking every negotiation. The World Bank cut its global growth forecast to 2.3%, stressing that high tariffs remain one of the main obstacles, Reuters.com. The consequences are broad: less liquidity, lower investment, and a slowdown in trade. If this cut happens, we could see global inflationary pressures ease and imported goods get cheaper. But there's still uncertainty around when this reduction will take effect and whether other trade restrictions might follow. Every step needs careful analysis to avoid surprises. This could reshape the global investment landscape. With lower tariffs, there's potential for trade to pick up, global supply chains to restart, and optimism to rise in stocks of exporters and companies with international exposure. A real opportunity for those who understand global dynamics. However, investors may remain cautious. After all, a sudden rollback could be reversed if political tensions flare up, making the move temporary and fragile. In this chess game, every move has deep implications. If tariffs go back up after July, it could catch the market off guard, with sectors reacting abruptly. Anticipating and monitoring the signals will be crucial for anyone looking to position themselves before the official announcement. Stay alert and up to date. Impact on the trucking sector. After COVID, there was an oversupply in trucking. Many drivers and companies jumped in, hoping to cash in on the trade boom, which saturated available capacity. Competition got fierce, and profit margins kept shrinking. Now, with fewer imports from China, demand for transport has dropped, and freight prices have collapsed, putting more pressure on companies' margins. This crisis is forcing many carriers to rethink fixed costs and routes. Combine that with high interest rates and heavy debt, and you have a perfect storm. Idle trucks, late payments, and cash flow at risk. The sector's sustainability is being put to the test. Consolidation in the sector has already started. Smaller companies are being bought or going under, making room for bigger players to expand through cheap mergers and acquisitions. For savvy investors, this is a rare entry point. Plus, there are indirect impacts. Truck and part suppliers and maintenance providers are also feeling the pinch and may offer interesting opportunities for watchful investors. Even the less visible links in the chain can present openings. Investing now means analyzing companies with strong balance sheets, contracts tied to domestic or international demand, and the ability to keep operations going even in tough scenarios. Careful selection makes all the difference. In emerging markets, this trend is mirrored too. The global slowdown creates ripple effects in local transport, port freight, and even logistics infrastructure. Tracking these cross impacts is essential. Retail and the consumer dilemma. Retailers see the potential tariff cuts as an opportunity to offer cheaper Chinese products, which could draw in consumers. The excitement is real, but will it be enough? On the other hand, credit card delinquencies above 90 days have hit 12.3%, the highest level since 2011, Payments.com. This shows the average consumer is increasingly burdened with debt and running out of steam for extra spending. Real wages are stagnant. While inflation eats away, housing, food, and transport costs are taking up more household budgets, leaving less room for discretionary spending. It's a cycle that saps confidence. The rise of buy now, pay later plans and personal loans highlights the fragility. Indebted families may cut back at the first sign of an economic downturn. An economy driven by credit has its limits. This creates a dilemma. Retailers might have cheaper stock, but if consumers can't afford to buy, sales stay low, unlike the normal consumption stimulus cycle. Pressure on margins will likely continue. Promotions and sales can create short-lived boosts, but the structural issue of consumer purchasing power still demands wage policies and inflation control to truly turn things around. Without these solutions, retail remains vulnerable. Investing in retail means looking beyond just gross margins. Tariff cost reductions won't translate to profit if sales volume doesn't follow. Every decision needs solid backing. Economic divergence. Two Americas, the investing class, shareholders, property owners, institutional investors, benefits from asset gains in a world of inflation and global liquidity. For them, volatility is opportunity. Meanwhile, the working class is struggling. Rising costs erode real wages. Many rely on credit and see debt and financial stress pile up. It's a world far removed from Wall Street's growth. This widening gap between those who profit from assets and those who live off wages creates social tension and potential political instability, which can shape economic and electoral decisions. These dynamics go beyond spreadsheets. The market tends to anticipate these tensions. Expect fiscal rescue plans, subsidies, or regulatory changes, all of which can affect sectors like healthcare, education, and infrastructure. Investors need to keep an eye on these moves. A cautious investor should balance protection in real assets, which hold their value, with geographic diversification to escape domestic political volatility. Prudence never goes out of style. Companies with strong social responsibility and ESG practices can stand out, but there are also opportunities in sectors directly tied to public or social infrastructure. It all comes down to analysis and strategy. Keeping an eye on public policy, unemployment rates, and consumer sentiment surveys becomes essential for any serious risk analysis. Information is power. Macroeconomic risks inflation. If tariffs stay high, imported goods will remain expensive, and those costs get passed to consumers, fueling CPI/PPI pressures. This underscores a need for investments that protect against losing purchasing power. High interest rates hit companies with debt linked to benchmarks like CDI or LIBOR. Banks like Deutsche Bank have already warned a rise in bankruptcies by 2026. This is a red flag that can't be ignored. It directly affects mortgages, loans, and consumer credit, raising the cost of money for companies and families. The risk of defaults grows as rates stay elevated. Large banks, like Citigroup, JP Morgan, have already increased provisions for bad loans, signaling they expect bigger defaults ahead. Fred, stlouisfed.org. Each quarterly earnings report tells a deeper story. Mild recessions following tariff spikes show that corporate credit markets have already priced in risk. Corporate debt spreads have widened since April. The signals are everywhere. The inverted yield curve and higher high-yield spreads point to general unease. This can delay expansion plans or lead to spending cuts. Caution and analysis are crucial. Anyone taking a macroprudential view should consider assets less tied to the economic cycle, regulated sectors, utilities, or inflation-linked fixed income. Diversification is key. Opportunities for investors, transportation, mergers and acquisitions in weakened companies open the door for bigger players to buy cheap and boost efficiency. This is a game changer for market. July volatility. The tariff decision could cause sharp swings in stocks, commodities like soybeans and oil, and currencies, offering tactical trading windows. Ride these waves. Inflation hedges, gold, real estate, and stocks of companies with pricing power, like utilities and basic consumer goods, stand out as classic portfolio protection. In May 2025, the S&P 500 was up 6.3%, boosted by the 90-day tariff truce. Global markets react quickly. Combined strategies can include tactical trades before the decision or rebalancing into real estate. REITs benefit from high rates and inflation, a mix that offers both stability and growth potential. Investing in sectors with external exposure, exporters, can generate alpha if tariffs drop, but watch out for technical barriers and sanitary standards. Timing and analysis matter. Alternative assets, like logistics-linked infrastructure, can pair natural hedges with long-term resilience in slowing economies. Think beyond the obvious. In short, the possible tariff cut on July 8 could ease import-driven inflation, give the transportation sector some breathing room, and accelerate consumption, but only if consumers have the power to buy. The duality between classes shows that not everyone will feel the effects the same way. While investors capture gains, workers struggle with the cost of living and debt. That's where crisis opportunities arise. Transportation consolidation, real asset protection, and market moves on key decision days. Be ready. Stay liquid. Study macro scenarios, and position yourself in resilient sectors. Volatility brings opportunity, and those who are prepared can ride the wave. And remember, your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth-building strategies.